So you've been out of the market for a year or two, right? And you're a little nervous to get back in, but you feel like you're missing out on a lot of gains. Can you wait? Should you be waiting? What should you be doing now if you are on the sidelines and wondering what that next step should be? Look, you're not alone in feeling this way. Today, we're going to cut through some of that noise and help you better understand the path forward. Welcome into All Things Retirement. Ben George with Anthony Aulffo, Cardinal Wealth Group. And Anthony, I think it's a good topic because right now, look, there's plenty of reasons to be out of the market for a lot of investors, right? They feel uncertainty. There's, conflict with Iran. There's just a lot going on. And I think a lot of people are just like, let me just wait and see. And that's how you end up being on the sidelines, isn't it?
Absolutely. And nobody likes to kind of go through these times where the market's not reacting how we want it to, per se. We get used to and comfort with, I'd say the last 5 years with, a little bit of market drops, but overall it's been a pretty smooth ride. So we like that consistency and not to see it go backwards even for a little bit of time.
Yeah. And if you're in this position too, the hard part is, hey, when do I get back in? Right. I mean, it's timing the market is pretty much impossible. So if you're trying to do it both ways, right, getting in and getting out. So, what are the next steps for someone that's in this position? That's what we're going to talk about today. If you have questions for Anthony, again, cardinalwg.com is the website. 609-362-5512 is the number as well. All that stuff's in the show description, so it's easy to get in touch with the Cardinal Wealth Group to begin your journey. But I want to kind of start with, for people that feel this way, I mentioned they're not alone, Anthony. So what kind of drives, how does this happen? How does someone get in this position to where they kind of feel stuck being on the sidelines?
Yeah, I mean, we're just not wired really for this. It's that fight or flight type of emotion. And I think research has shown that losses hurt twice as much than a gain. So, that fight or flight, it's just one of those things where we're kind of wired really for the short term, even though most of us say that we're long-term investors. So that's generally the main challenge.
Yeah, it's like coaches, right? They remember the losses a lot more than they remember the wins. It's the same way with investors, probably, in any area, right? You remember those failures a little bit more than the successes. But I think what's important with this conversation is really that cost of waiting, right? So I want you to kind of explain that for people that are sitting on the sidelines and saying, okay, well, I'm not missing out on a whole lot. I'll get back in eventually. But there really is a true cost if you are sitting on the sidelines.
I mean, we certainly hear it all the time where people say, I'd like to see it kind of turn around before I get in. Ultimately, what you're really doing at that point is buying as it's getting higher. And a lot of times people, get cautious as they see things going down, and they're selling as things are dropping. So it's kind of counterintuitive. And research has shown when you miss 1 to 10 of those biggest return times, even if you just missed the top 10 stock market rallies in a 10-year period, you could literally be leaving close to half of that 10-year return on the sidelines. So it's really important to be able to kind of stick through it. Obviously, getting to the right asset allocation and risk helps you kind of get through some of that. And just kind of reminding yourself going through from this is not unlike anything we've been through before. The last 100 years, we've been through a lot. And the market has still kind of returned that 10%. But in order to get that 10% average, you really have to be through the good and the bad.
Yeah, I think that's the first thing, right? Is remembering those, missing out on a few of those days. And we've seen it here in recent years, when the market's had big drops, it's rebounded very quickly. And just sitting on the sidelines during that, again, you could have missed out on recuperating all those losses. So that's one thing to remember. And the other part of this too is that cash might feel safe, but look, we've seen inflation. And if you're sitting there just in cash, you're probably not keeping up with that and you're losing buying power, aren't you?
That's right. Yeah. It generally makes us feel good having that cash on the side, but in reality, you're still losing to that inflation, the cost of things getting more expensive. Banks aren't just giving away money for free. They're generally making a difference on that. So really, in order to kind of keep up with inflation for most people's spending or future goals, we're going to have to take some type of stock market risk. And it can be calculated, right? That you don't have to put all your dollars into the stock market. Most people have some type of blend of stock, bonds, and cash. depending on their preference there. And that is really what's going to help balance that risk and reward and deal with future expenses getting higher and offsetting that inflation over time.
Okay, so just because it feels like nothing's happening because you're not invested, right? That is the trap of this all. There are things, there's a real risk there of being on the sidelines. So that's kind of what you need to be thinking about here. So to better understand the market though, Anthony, for investors that are, okay, well, I want to get a better feel for why the market moves, how it's moving. So help us better understand that from an investing standpoint, what to truly understand.
I think that we probably will talk about this every month to our clients, whether it's in a form of, say, a newsletter or just having meetings with them, especially when times are like this, which feel a little bit tough or queasy. But really just saying, as a long-term investor, you're there to participate in the earnings and profits of these publicly traded companies. But those returns to you can, be erased in the short term. And when I say short term, 1 to 3 years, the market can be moved by other avenues beyond the profits and earnings of these companies. You're talking about momentum, headlines from geopolitical events, the news, interest rate speculation, greed, fear, like buys, sell-offs. So some of those types of events in the short term can offset some of the gains that you might have had over that long term, but ultimately how you make money over time. If you take a lens of 10, 20, 30 years, you didn't make money, generally speaking, from the market, news, interest rate speculation, geopolitical events. You made money because those companies make money, earnings, profits. They pass it on to you as an investor. And that's really the simplest way that I can kind of go over it with our clients, and just to remind them that we get rewarded over time for sticking with those profitable companies.
Yeah, that's a good reminder. So as you're kind of thinking about this and knowing that, look, timing is very difficult, right? I mean, we might hear about people having success and all the wins that people have. Nobody highlights their losses. So it might seem like there are people out there that can time the market well, but we know that that's not the case, right? So how should you approach investing? What's the best way to kind of look at this and keep that perspective in mind?
Yeah, I mean, that's kind of that gambler's folly, right? Or like, I was up at the casino, and then, if you kind of take a big spectrum of that, the math, if you add up the gains and losses at the casino, usually most people are down. Some people can be consistent in the short term, but most research has really shown that it's very difficult to time the market. So taking a longer term approach. And I think this, whole topic today is really about, getting back into the market. And so maybe just jumping right in is not going to be the best way for somebody, especially if you're having some aversion to it. But maybe kind of starting to just put money in. Dollar cost averaging could be a way to do it, putting money in over a monthly basis or quarterly or 6 months. That would be maybe one route to go to start to just kind of drip back into it versus just putting it all in there. I would say though, if your time horizon for this money is greater than 5 years, I don't think that there's a inherent risk to putting it in all at once. But if we're talking to people just to get them to make a behavioral change, then I would be gladly and welcoming to just saying, hey, if we can just maybe move into a monthly drip into the market, that would be probably the best way that I could foresee somebody going into it. And also just reminder, again, we're not saying to go 100% into the market. You could put in 10, 15, 25% as a starting, and then kind of ratchet your way up if that's the best way, as somebody can really see themselves making a change off the sidelines.
Yeah, I think changing behaviors the goal there, right? I mean, even it's gonna be different for everybody. You might be more comfortable with putting more in right away. You might want to wait a little bit longer, but just trying to slowly get back into that is important. And look, it's not about predicting the markets; it's about planning, right? And that's again where at the Cardinal Wealth Group, that's where you can have that free assessment, begin talking about these things. I mean, this is part of that conversation, I'm sure, when you meet with someone for the first time, Anthony, that you're talking about investments, because that's probably what most people want to hear about right out of the gates, isn't it?
Yeah, absolutely. I think that one of the biggest challenge, if I can think of a person that we come across from certainly multiple times throughout the year, is that person who's always kind of felt like they've been on the wrong side of the trade. Every time that they try to get back in the market, something happens. So in their scenario, it could be a time like this, and then they go back a little bit in history. It could be the start of last year when the tariffs were kind of rolling out and the market was down about 15% by March 30th. Or you go back to 2022 and then you look at COVID. So you can see people like, trying to get into the market, wrong time, then they get out and then they talk to a friend or the fear of missing out, they get back in and they get kind of beat up again at another event, because these things do happen. But if you can just stick through it and let the market work for you and give it, 3 to 5 years, most people are going to be up, and then they can kind of see that their account's growing and start to outpace the short-term news, allowing those earnings and profits to repay you over time. But it can be a challenge for some people for sure. So planning certainly helps, and working with an advisor that's advocating, I think certainly can help most people.
Yeah, if you want to begin that Cardinal success journey now, just log on cardinalwg.com. It is in the show description as well. You have the link there to get in touch with Anthony as well. But look, if you're on the sidelines, you are concerned about the volatility or thinking about going to the sidelines, right? Put a plan in place now that you can kind of block out a lot of that noise and stay focused on your goals over the long term. Hopefully this video has helped you. If it has, please subscribe to the show, to the channel. This is All Things Retirement. We'll have another episode coming soon. Anthony, talk to you then.
Thanks, Ben. Take care.
Information provided is for informational purposes only and does not constitute tax, investment, or legal advice. Please consult a qualified professional before taking any action.